Now that we've wrapped up the inventory account on the balance sheet, we're ready to tackle one of the biggest topics in intermediate accounting: long-term assets. These comprise anything expected to provide economic benefits for multiple years, and we're going to go through the whole life cycle of these. We'll consider what needs to be taken into account when companies acquire long-term assets. How should they be depreciated or amortized over time? How do we account for subsequent expenditures and other events? And finally, what happens when those assets are sold or otherwise disposed of? For now, we're going to start with that very first step. Whenever a company acquires a long-term asset, the first question is, what exactly should become part of that asset's recorded cost? Which introduces a very important idea in accounting: capitalization. I've framed this concept around three main questions: what, why, and which. So, what does it mean to capitalize a cost? Essentially, it means that we're going to initially record any expenditure as an asset to be later expensed in some future period. Just like inventory, there could be a variety of costs that we incur that are related to the initial stages of when we acquire some fixed asset. Some of those might be immediately expensed, but others will end up getting added to the total value of that asset's historic cost that goes on the balance sheet. And the reason why we do this relates back to the matching principle. As mentioned before, long-term assets are expected to provide benefits over multiple, even many years, sometimes several decades. The matching principle requires the accountant to recognize expenses in the same period as the revenues that they help to generate. So, as a result, to capitalize a cost really means that we're trying to pair all of those initial related expenditures to a long, useful life, and thus depreciate them over a longer time period. The alternative would be just expense the entire thing in the current period's income statement. So, if we know what it means and why we do it, we're left with the question of which costs get capitalized. As a general rule, we're going to capitalize all costs that were necessary to acquire the asset and prepare it for its intended use. Just like inventory, all those expenses need to bring an asset to its proper condition and location. There are a bunch of different categories here, so I'm just going to discuss a few major ones. Let's start with buildings. We're obviously going to capitalize the purchase price of any asset we acquire, but transactions involving buildings are often facilitated through real estate agents. So any buyer's commission can be capitalized. A company might purchase an existing structure, or it might engage contractors to construct a new building, and those construction costs or fees paid to architects or engineers can also be capitalized. There's even some interesting accounting considerations where the interest expense incurred, if necessary to finance the construction, can also be added to the building's historic cost. We'll do some practice with that later. Lastly, capitalized costs can also include expenses related to remodeling of a building, so long as they are incurred prior to occupancy. And that really is an important part of the timeline here. Once the building's transaction has been processed and you're ready to move in and use the building, any subsequent costs incurred will be fully expensed in the period they are incurred. This could include things like routine repairs, a variety of services like the utilities or insurance paid, and subsequent property taxes. Let's now move on to land. As a quick reminder from prior coursework, remember that land is unique among fixed assets because it has an indefinite useful life. In other words, it's not depreciated. Any of the costs that we incur that get capitalized, they're not going to show up as an expense on the income statement at all. Again, we'll naturally capitalize the purchase price, and that's usually the biggest expense, right? But not always. The sale of land might require some sort of county recording fees to document the transfer of title. It's also possible that the land needs to undergo some serious preparation involving surveying, grading, filling with dirt, draining of water. even the demolition and removal of previously existing structures. If you need to incur these to get the land ready for use, then they can be capitalized. And after that point, you might pay for landscaping or snow removal services. They're related to taking care of the land, but these costs would simply be expensed, again alongside with subsequent property taxes. Let's do one more example with equipment. When we're purchasing equipment, we're probably also paying sales taxes in addition to that purchase price, and any other associated transportation cost to deliver the goods to us can also be capitalized. This also extends to any cost incurred to set it up, install the equipment, do some test runs, and calibrate the equipment. And again, after all that's been done, any routine maintenance or the supplies and electricity needed to operate the equipment, those are just expensed. In general, I hope you're getting the takeaway that you don't really need to memorize all of these individual possible expenditures per se. It's much more important to focus on the generalizable principle that any cost you incur that's necessary to get the fixed asset to its proper condition or location, those can be capitalized. So far, we've assumed that the dollars and cents going into these transactions is cut and dry, where it's always clear the costs that should be attributed to various assets. Before concluding this video, I want to discuss concepts relating to some special considerations. Getting these in your head will make things smoother when we do the accounting later on. First, we've got lump sum purchases, where it's actually not unusual for a transaction to include the purchase of multiple assets all at once. If there are any costs that are unique to a particular asset, they should be separately capitalized, but any shared acquisition costs for a transaction, they need to be allocated, and we do so using each asset's proportionate fair value. For example, if we're buying both a building and the land that it's sitting on, it's pretty important to accurately determine the fair values of each of those and split the transaction price and any other shared costs separately to the land and building based on their fair values. Next, there are a variety of situations to consider that involve non-cash acquisitions of long-term assets. For example, some purchases might be financed by the seller. Some might be purchased by issuing additional equity. But the scenario that I think is most interesting and that we're going to focus on during lecture involves exchanges of assets. So, while we use depreciation as a tool to allocate the cost of a fixed asset over time, it's possible that certain assets, particularly real property, they might increase in value over time. But accounting conservatism, that prevents companies from writing up the value of these assets. Any potential appreciation in property values, that can only be recognized when the company has sold the asset and thus realized the gain with an arm's length transaction. And this is where exchanges of assets comes into play. We're going to talk more about the what later on, but for the time being, just picture using an exchange as a sneaky way of trying to recognize unrealized gains without having to actually dispose of the substance of the asset that the company needs. For now, let's just remember the rule that in order to recognize gains from the exchange of assets, the transaction must have commercial substance, meaning that the exchange is expected to significantly change the entity's future cash flows. Lastly, we've got the topic of asset retirement obligations. An asset retirement obligation, or ARO, is some legal obligation to remove a long-lived asset or restore the site when it is retired. These obligations are most common in capital-intensive industries like oil and gas, mining, nuclear power, utilities, and waste management, where companies may need to plug wells, close down mines, dismantle facilities, or remediate the land. At the time the obligation is incurred, the company is going to record the expected retirement cost as a liability, but they will also capitalize the same amount as part of the asset's cost. Now, recall, these obligations could be many years down the road, so we must use the time value of money to record these future expenditures at their present value. All right, well, you're now much more familiar with the accounting considerations at the time that fixed assets are acquired. Let's keep going now with similar considerations relating to non physical or intangible assets.